So panel, let's start off with the obvious question, which I think is the whole basis of this session, and that is, what is capital stewardship and what are we talking about? So Emma, why don't we start with you?
Sure. So you've hit the nail on the head with those two questions. So thanks for everybody for putting both of them. But I think there's a couple of more elements within there as well. It's got to take in the characteristic of long-termism. So it's not short-term capital. It's over periods of time and responsible ownership. For the sake of this hour, I would narrow it down and say it's also within that active voting. So that's not tick box. It's active dialogue or engagement with companies where you see a risk. It's just another investment tool that you can use. And also, we've got to say integration of ESG factors into the investment process. So you've got that overview, but I think for this session, I would probably focus on those three specific elements.
Okay. Nick?
Yeah, I would echo that, but more broadly, I think an umbrella term, the way that we approach capital stewardship is very simply looking after the capital that investors have entrusted us to invest on their behalf. Sounds very, very simple, but when you drill down into each of those points, you start to get to the areas that Emma's highlighted there. So what actually does looking after capital involve? That's the interesting part.
From my perspective, I would say it's time and market dependent. For example, the way that a German pension fund immunizes its obligations from a regulatory compliance, let alone from an ESG perspective, can be vastly different than from a perspective of a UK fund. So is one better than the other? Is the German approach better than the Dutch approach? Is the Dutch approach better than the Australian approach? It really is dependent on the conditions that we're in. As far as the market condition, I do believe that we are now moving from a volatile market to a highly uncertain market. The difference between the two is, again, volatility is a statistical measure, whereas uncertainty, GOK, God only knows. And again, how that relates to our obligation of immunizing this pension and how we deliver it can be vastly different.
So Emma, you mentioned ESG. If you are a fund and you have an ESG policy, is that capital stewardship covered then?
No, definitely not. ESG, look, it's just one element of it. But if you can see some risks that are impacting the investee companies or the markets in which you're operating in, we might touch upon Japan later, for example. There's things that you can do as well beyond that. So I wouldn't just focus on the ESG. It's engagement, it's dialogue, thinking about the marketplace and thinking about those investee companies.
Right. And Nick, I'm interested, who are the capital stewards? Is it the people sitting around the trustee director table, or is it the fund managers, or is it the investment advisors, or is it government?
Well, look, if you think of a production chain down from the very top to the end users, essentially Emma and I were discussing before we came on how interesting it is for folks like us in our profession to be interacting regularly with the very end users of the things that we're manufacturing. So that is your guys and girls who've been working for a company for X amount of years, who are ultimately approaching their retirement. At the end of the day, they're the end beneficiaries. Now, they are at the end of a very long production chain, and there's stewardship at various stages along the way. So in my role in fixed income, obviously I'm effectively overseeing capital from a lender's perspective for those end users, but I too have been given that role by someone else who is also a steward of capital at the trustee level, maybe even at a consultant level, for example. So there's various links in that chain, all of whom should have a vested interest to be looking after end users' interests rather than their own. So I think that's a key part of what we're talking about.
I'd probably jump in a little bit here and say, agree with that. But let's think about who today's capitalists are. Today's capitalists are those end savers. It is the man or woman on the street at 5 o'clock in the morning, he's walking along, saving their pension. So there's who the capitalists are, and then who's the stewards of that capital for those capitalists.
Yeah. And Rob, just taking Emma's point, are you seeing anything either in Australia or elsewhere that person on the street who is the owner of all of that capital, that they're taking more of an active interest in how that capital is invested and the investee companies, how they operate, and demands on trustees that are making decisions on their behalf, how that's being done?
I'd like to answer that by asking, I guess, the audience a question, and that is, we're all involved in superannuation. We're born and bred in it. How engaged are you with another important thing that we're trying to immunize? Healthcare. How many of you know and are engaged with your health care provider? How many of you know what the reserves are? How many of you know how well placed they are to deliver and cover your future healthcare needs, be it a hip replacement through to something that you may not necessarily need anymore, birth? I think the same question can be done to the person walking the proverbial dog. Sadly, it is demographic related. Sadly, it is need related. The closer you are to retirement, the more engaged we become. For us, if we are engaged in healthcare, it's perhaps getting rid of changing our policy from birth to something that we may be hitting in the future, hips. So either way, it's a need-based and can be based on demographics.
Okay, so let's delve into a bit of detail about capital stewardship and some practical examples. So first of all, we've got many funds in the audience representing billions and billions of dollars of assets under management. Why is capital stewardship something that is worth these people paying more attention to and giving time around their meetings to be discussing and looking to become a better capital steward? So,
I can have first.
Emma, you go first.
Sorry, my thing keeps on falling off my ear because I think my ears are too small. Look, there's 3 reasons. It's embedded within fiduciary duty. Preserve the capital. At least don't lose people's money. Let's take that to the prudent man concept. So you've got responsible ownership, you've got long-termism, and you've got to think about the man on the street as you're doing this. So there's the fiduciary duty element. Alluded earlier, it's just another tool for managing investment risk. Why wouldn't you do that? In a recent study, one of the things that our firm does is to engage with companies, and we've been trying to track their performance. So we let a wild academic loose on our data set, and they've worked out that engaged companies outperform non-engaged companies by 4.4% per annum. Look, that's a lot when you take that over time. So it's managing risk, and it's good for the fund as well, good for investment returns. I'll probably leave it there.
Okay, Nick, do you want to add anything to that?
No, I'd echo the whole why should we bother. Ultimately, it does come back down to better long-term outcomes for capital owners. If there weren't better outcomes, and you can define better in a number of ways, one thing we're keen to stress at Aberdeen is, for us, capital stewardship is not about seeking the best return. Capital stewardship doesn't necessarily mean, well, I earned 10%, therefore I stewarded that capital better than the 5% return, because that 10% could come with an awful lot more downsides or risks. And that whole idea of risk management is really a key plank of capital stewardship, as Emma said.
Yeah. And Rob, do you want to add something?
Well, I would take a step back and really focus on what Tom said at the beginning. One of the darkest days that our industry faced is post-GFC, when people, out of fear, pulled out, thereby cementing their losses. You could say the same thing about Brexit. If you recall, when you turn on the news, and Brexit was the beginning of the end. The political society as we knew it was going to decay. And yet, of course, right now you would say, what? What Brexit? So those who actually sold out, again to the GFC example, who sold out of fear because the media was selling them fear, responded and reacted. So back to all-encompassing, how do you manage that from a stewardship? Communication, engagement, again, echoing Emma's comments earlier.
Can I just add something? I get very excited about the comment that from 2008, markets are back up. So we've lost some, and if people crystallise their losses at that point, that wasn't a good decision. Markets are back up, we're okay. I'll choose a UK figure, but really it's echoed around the world. $1 trillion, or £1 trillion, sorry. So that's the equivalent of your 2 trillion collective funds within this room, really. That debt has been transferred to the government. So it's been taken away from financial markets, but it's not gone away. It's gone to the governments. And I think this is a really interesting point when we come back to robust markets and capital stewardship and holistic returns that you touch on. It matters. It matters what the market's doing. It matters that we're in a VUCA environment, regardless whether it's debt within the investment markets or within governments. That's just a side point, really.
Okay.
I get excited about it.
I want to go back to that poll that we had up on the screen at the start of this session. I'm not going to ask you whether Hawthorn's going to win the premiership this year or not, but how would you have answered that poll? Would each of you have selected the both of the above options, or would you have? You would have? No?
Well, there wasn't an option that said both of the above and then some, which is the one I would have gone for.
Yeah.
But in the absence of that, it would have been that one.
Picky.
Yeah. Rob, I see you shaking your head. What would you have said?
Return is, we can't predict returns. We can't drive returns. We can't manage returns. Returns is a function of the market to which we're a participant therein. We want to maximize it. I've yet to meet a fund manager with hand on heart and say, my asset class will deliver a CPI plus. My asset class is cheap. I've yet to meet one. If you have, please introduce them to me, because I would love to invest in there as well. So it is return deliver. It's a conflict, isn't it? If you think of what pensions and why the government introduced superannuation, it's a conflict between its caveat emptor, but at the same token, it's taken away the responsibility of taxpayers to fund an individual's retirement. We baby boomers have screwed generations X's and Y's. We had free education, we had free healthcare, we have free everything. And now the Gen Ys and the millennials are struggling to buy a home, let alone to access all this sort of stuff. So the introduction of superannuation is true, but right now, at least we're beefed up. We have a capital base, but delivering the sort of CPI plus return environment that we need, that's wealth accumulation, that's not wealth immunization.
So with capital stewardship, where should the focus lie more? Should it lie more on focusing on the investment mandate and the investment return to members, or is it more on about the ethical principles that many people in this room are committed to around ESG and trying to improve corporate practice in those areas?
Okay, so I'm going to pull out, you've brought in two principles there. One is potentially ethical principles, and I don't think that's what we're talking about when we're talking about capital stewardship. You can have ethical principles within your investment beliefs, and that's absolutely fine, but that's not a core part of this discussion, I would argue. And then the second was, can't remember. Come back to me.
The returns to members.
Oh, yeah. Well, I'd say they've got quite a symbiotic relationship. If you've got a successful, well-performing company, that's going to give you better long-term returns and therefore look after that cycle. So it's a symbiotic relationship. Is it about CSR? No, it's not. Is it about investment returns? No, it's not. But is it about the symbiotic relationship between the two? Absolutely, because value is made on Main Street, not in Wall Street, when we're thinking long-term anyway.
Yeah. Nick or Rob, do either of you wish to add anything to that?
Well, again, going back to the returns, apologies to Warren here, but have any of you ever read any books on pensions that say the best way to immunize is to be top quartile? I haven't. And yet we're consumed by this ancient's dilemma. Where are we ranked? So we look over each other's shoulders. If you think about a variable annuity fund, they're probably the truest approach on how we should be managing pension. What is the return requirement that we need to deliver? It's funny how we all tell our members a balanced fund is CPI plus, 3, negative return, and 1 in 7, 1 in 8, and this much downside. Yet if you look at the asset allocation between growth and defensive assets, it hasn't changed in 15 years. There's a disconnect here. And that's what I would like to argue. That's what I call about stewardship. Stewardship, again, for what we're trying to do in delivery of pensions has become a wealth accumulation. And we're not. We're not that. We were very fortuitous that when Paul Keating introduced superannuation, it was the start of a 20-year bull market. As I always tell people, if Paul Keating was Japanese, this conference would be 1/3 smaller and would be in Parramatta.
Okay, we've got our first question up on the board, and it's something that we've already touched on, but I think we should cover it still because it's obviously still a question in people's minds. So why is capital stewardship different to ESG? And I think most of you described ESG as something that could be a factor in capital stewardship and an ethical overlay that goes into it, but it's not necessarily a prerequisite to being a capital steward. So I guess taking that question and extending it, can you be a good capital steward and be heavily invested in tobacco and a very high carbon portfolio? Who'd like to have first?
Yeah, no, I can comment on that. I mean, I think why is it different to ESG? It's not different necessarily. If you imagine a Venn diagram, where you've got a big circle which is capital stewardship, and then you've got another circle which is ESG, and there's a significant amount of crossover there. We wouldn't deny that, but there's also some areas in there that you can't just squash into a nice 3-letter acronym like ESG. So when we're thinking about capital stewardship, it's about a myriad of investment risks. If I'm going to be a good steward of the capital that all of these folks have given to me, I need to be really alert to investment risks, however they might be pigeonholed. So some of them can be put into a nice handy box and something around ESG. Some of them may not. It could be an investment risk that we need to be aware of that doesn't handily fall into those boxes. So that's the first point. The second point, which is around, can you be a good capital steward and be investing in sectors that may not be flavour of the month? Yes, you certainly can. So for us, capital stewardship is not about a values-based overlay, because they would be my values or Emma's values or Rob's values. There are differing views on biotech, for example, and on genetic modification. Some would say, look, this is a very valid area of investment because it will enable us to feed all the humans on the planet. Some would say, oh no, we can't go mucking around with genetics because that's not ethically right. That is not an example of capital stewardship. I mean, just by way of, a side note, carrots are one of the first genetically modified foods out there. Most people would happily eat them, but it was actually the Dutch that first created an orange carrot for the House of Orange centuries and centuries ago. The original carrot in its natural form is actually an off-white colour. So GM has been around for many, many centuries, so we can't demonise it. What am I rabbiting on about? My point is, and I'll get there, don't overlay values-based judgments on the idea of being a good steward of capital. If we're looking at the resources sector, I want to be looking at the best companies in the resources sector who have the best risk management practices, who have the remuneration of their board aligned to long-term interests of capital investors. I want to see that they've got safeguards in place so that they can manage the inherent risks of the sector they are in. We're not going to demonise them just because they happen to be in a sector that isn't flavour of the month. So they're different things.
So is capital stewardship then just a term that describes what we've always been doing? 100 years ago, the owners of capital would pay attention to how that money was invested and the returns that it generated.
Well, I'm not sure. I'm not necessarily sure about that. So, Emma, you raised a good point, which is around this idea of active engagement. So using your votes as a capital owner. Don't just tick all the boxes that come around. Be involved with a RemCom. Have input into remuneration committee. Have input into how directors are compensated. 20, 30 years ago, that may not have been the case. It may have been, there may have been an aversion to clashing with boards about areas like remuneration. That can't really be the case going forward.
Okay, so let's get into some of that detail now. So what are some examples that you can point to that shows capital stewardship in practice and achieving good results, and examples that perhaps might be of interest to people here to emulate in their funds? So let's start with you, Rob.
Japan would be a great example. And I would argue that ESG or stewardship, whatever, can be a reflection on the size of the market per se. So Japan, back in the 1920s, had a greater capital ownership, or share ownership, than much of the West. Statistically, there were a larger number of Japanese households that held shares in the early 1920s and before than in the West. Then, of course, the Great Depression hit, and they chucked out share ownership. They changed everything from government policy all the way through share ownership. But recently, the government has realized that with interest rates the way they are, that they're going to have to encourage share ownership. And they began to change laws. Some of the laws relate to, again, kind of what we have here of different taxation rates. If you hold an equity fund less than 3 years and churn it, you get taxed at a higher rate. If you hold it post 3 years, you get taxed at a much lower rate. Then, of course, there's the ESG initiatives and UNPRI. The advances that Japanese corporates have undertaken in the last 10 years, given that they came from very low base, are extraordinary. And then lastly, even the pension funds themselves, the big one, GPIF, which has over $1 trillion, they're beginning to look at, again, factors. They've even created an index based on ROE. Now, for a country like Japan that had no equity culture, that, again, embracing of the stewardship and the ESG principles, amongst many others, is quite exemplary.
Okay, Emma?
Japan's a great example, because it's so live. So one of the things that we've noticed, and so that we're responding to, a lot of our clients are heavily invested in Japan, one of the largest markets in the world, but they recognise that their companies are limited because of all the cross-share ownership. So on the boards, that means there's no independence on the boards, they're very related, they have symbiotic relationships, and therefore one board, the independent directors, if there are independent directors, they find it very difficult to do proper oversight, proper challenge to XYZ board because they're so vested in that company. So there's this big problem of cross-shareholdings. Now, because the cross-shareholdings are with a lot of the Japanese directors on those boards, they're too vested in trying to pull this apart. But it's an area that Abenomics have identified that we can only move forward if we begin to unpick all this, so we can get these independent boards, so we can get the quality governance and the quality oversight. So this is where they've looked to overseas international investors that are not vested in those boards in the same cross-shareholdings. So one of the things that we're doing is we've put a lot of investment into looking at this issue, but we're not doing it by ourselves. We're doing it with all our 40-plus clients who are engaged in this issue, but then we're pulling upon big asset owners and investment managers from around the world to say, right, Abenomics, they've said, please help us sort out this big long-term capital and governance problem. And so that's what's happening. So we're pulling in relationships, partners, networks from all around the world, from asset owners, asset managers. We're spreading the word amongst consultants, kind of everybody, right? Yeah. So is it a capital stewardship issue? Yes, it is. It's a limit to market development and growth, potentially. That's certainly something that the Japanese government and market commentators are saying. And so we're bringing in all the owners of all the shareholders which don't have vested interests because they can't do it themselves, to try and release that. So it's a very live example. It's going to be a difficult one.
Yes.
Very.
Nick, are there any examples you'd like to touch on?
Yeah, certainly. So, I mean, clearly I'm coming from the perspective of a lender. We're a fixed income investor. We're not, in my division at least, we're not necessarily capital owners. But I still think the broader concepts of good stewardship of our investors' capital apply here as well. So one example is, which should be quite pertinent actually to Queensland, is the Adani Abbott Point coal terminal. So the interesting angle here, we did a lot of background research with our colleagues equity colleagues in Singapore, who are very familiar with the Adani family through their other investments in the region, and we could not get comfortable enough with the G element of ESG. This is where there is a crossover with ESG and capital stewardship. We could not get comfortable enough with the G element, given some of the examples of other things that had happened with IPOs in India, for example. And even though we like the asset, still like the asset, long-term take-or-pay contracts, actually quite nice, fixed income-friendly cash flows, we couldn't get comfortable enough with the G aspect, and we didn't invest. And subsequent to that, actually, the bonds have had an interesting ride along the way. So it's just a practical example of where, you know, we need to be really looking and thinking a lot more than just what's the individual asset we're investing in, and trying to think more broadly.
Okay, Emma, you wanted to add something?
Yeah, I might throw in another example as well, which is about the Aiming for A shareholder resolution campaign. So the Aiming for A this year was basically about a shareholder resolution to require 3 large resource companies to release their carbon emissions, or release data on their carbon emissions, and do some scenario planning around the 2-degree scenario. So it was Anglo American, Glencore, and BHP, the big ones, right? Behind closed doors, they went, no, we're not going to do that. We're not going to do that. But we see your point. We know we should do it because it's data that's important to investors, and it's important for us. We know we need to get a plan. We explored this with them over a period of 18 months. Well, why aren't you going to release this data on carbon emissions? Why aren't you going to release how you're going to work to a 2-degree scenario? Well, if we release that, we're releasing out to our competitors as well. So we said, we'll put the resolution to all 3 companies. It ended up being a company-backed shareholder resolution. That's really unusual. So the question we get often was, if it's a company-backed resolution, and the chairman of each of those companies came out in the FT and said, we back this resolution, well, why is the company not going to do it anyway? Well, it's because they want to move forward, but they want to make sure that their competitors are moving forward as well. So this is the idea that a market or a sector is best dealt with as a market, as a sector, and sometimes not as individual companies. So it's working together with the companies and with other asset owners and investment managers from around the world to really show support to let the companies do what they want to do, but feel constrained because of market elements too.
Great. Rob, I think you wanted to add something?
Nick, I'm intrigued by the comment you gave, particularly as a bond manager, or as you said, a lender. At the end of the day, as a lender, and the broad industry, mind you, their main concern, of course, is to get their money back. As a manager of an equity, we don't have that luxury.
No.
To again get that money back. But there seems to be, and this is a sincere question, there seems to be a cross, if you like,
between lenders and owners.
Correct.
Yeah.
In as much that now even the government says, okay, no bond shall go bad. You know, the bigger the debt, the more likelihood that the ultimate holder of the debt is a taxpayer. So there seems to be, with the GFC was a great example of that, and potentially so could pension obligations. If SMSFs do it really badly, let's face it, we're going to own that bad decision as a taxpayer. Again, superannuation was introduced to take away a liability from future taxpayers to the individual. But yet in the bond market, some of these bond issuance, the ratings, of course, as jokes. So I'm curious how, as a management firm or as a manager, you managed around that.
Yeah.
Because that varies asset to asset, doesn't it?
Yes, it does. And that's an interesting question. So Aberdeen has got 7 key principles of capital stewardship. There's an interesting document that's available on our website. It's a shameless plug there. And in that, we do explicitly deal with this perceived tension between lenders and asset owners. Don't you always want different things? Doesn't an equity owner always want to lever something up to the max and get the highest ROE by virtue of manipulating the capital structure? But we would argue no. In the long term, actually, 9 out of 10, the interests are actually aligned. So, for a bond investor, yes, we care about ultimately getting our money back, but the journey along the way to that point is very important to us. I want a I don't want a wild ride to that end point. I want a fairly predictable ride to that point. So you're arguing for, relatively long-term, stable businesses that show a sustainable return on capital, not a super elevated return on capital in the short term. They show a sustainable, gradual return on capital. So I think in most instances, the things that an equity owner, particularly a long-term investor rather than a short-term one, most of the things that they would like to see, a bondholder is going to say, yeah, that makes sense. This business is going to be around for the longer term. It's dealing with its competition. We're not going to get, we're not going to get taken out by competitors. Of course, I want to be concerned at the top of the tree that we've got safeguards in place. But most of the time, 9 times out of 10, when we're talking to our equity colleagues where we both own and lend to the same company, our interests are aligned the vast majority of the time. I mean, ultimately, you're the equity owner of a business that has a net asset value. As a lender, I want that net asset value to be higher as well. So does the equity owner. The higher the net asset value, the safer I feel as a debt.
But consider this, if you're a pension fund and you're an owner of, let's say, Chase Manhattan debt, and you're the same pension fund owner of Chase Manhattan shares. If you're the shareholder, bye-bye.
Yeah.
But if you're the bondholder, you got money back for the merger.
Well, look, let's bear in mind that after the crisis, most regulation is working towards ending too big to fail. So, bondholders are now an explicit loss-absorbing part of the capital structure of banks.
Okay.
So, additional Tier 1, Tier 2. In Europe now we have bail-inable senior debt. So, Germany has bail-inable senior debt. As a bondholder, you are there now as a stress absorber. You're there as a shock absorber. The only person who's sacrosanct in the bank capital structure now, really, is the end retail depositor.
And management.
Well, there we go. None of us work at banks, so we don't have that liberty. But I would say looking at a bank is a very unique or relatively unique example. But I would say debt holders have plenty of skin in the game, especially with loss-absorbing capital being far more prominent now.
Fair enough.
Okay, we've got just over 10 minutes remaining. So can I encourage questions from the audience? We've got some on the screen in front of us, so let's perhaps tackle those that we have there now. So first of all, maybe for you, Emma, is there a greater focus on capital protection in stewardship for superannuation members? Should that be the focus?
Greater than what? Is there a greater focus greater than what?
Greater than other... Well, I think the person who has asked that question is interested compared to other aspects of capital stewardship. Should the focus be on preserving capital as opposed to...
I mean, that's the first rung on the ladder. Don't lose money or don't lose your end savers' money. So, yeah, definitely. But that's only the first rung of the ladder. The next is also that person who's saving that money, they're going to be doing it for 10, 20, 30, 40, 50, 60 years. So at the moment, we overemphasise the present at the expense of the future. And that probably is a mistake, actually, given the 10, 20, 30, 40, 50, 60 years. So don't do anything now that's going to impede that person's ability to get successful returns or preserve the capital in the future.
Yep. Okay, now, it wouldn't be a super conference if we didn't have a question on the banks. So some critics of banks have talked about a social licence. Is a social alliance a myth? Who'd like to have a go at addressing that question? Nick?
I'm going to be extremely ignorant here and say I'm not sure what is being comprised by a social licence. I think it may be something around a social contract. The idea that banks are fulfilling a role, they're uniquely entrusted with a role that everybody has to have happen to their money, and yet they are, well, until now, they were, seen as essentially, under-regulated maximisers of returns rather than as a utility. So I might be going completely off track here, so apologies to the person who asked that question, but, I'd say that increasingly banks, retail banks particularly, are recognised as having a utility-like function, and guess what? Their ROEs are reflecting that, and they're being regulated as such. So, more capital, lower returns on equity, more vanilla businesses, more disclosure, more accountability to Parliament to to end investors. That's the future of retail banking. In effect, we're going back to an area where you could see genuinely 100% sort of private owned, almost like the old merchant venture capital style banks, where they wouldn't be regulated, but it would be all the owner's capital would be the skin in the game, as opposed to a regulated utility like retail bank, which is performing a social function, who should not be there for the taxpayer to bail out. So you're seeing effectively that separation. Banks like Barclays, looking at carving out the different parts of businesses, are responding to that pressure.
Okay, I've got a couple of good questions up there now, which I think sort of get to the heart of what it is that we're talking about, and perhaps is a good segue towards the conclusion of this discussion. So, first of all, how do you build stewardship into investment mandate agreements across various asset classes? So, when the rubber hits the road, is there a place in the actual mandate itself for capital stewardship principles? Do you want to, Emma, start off with that?
I think very simply, yes.
Yeah. And so what would it look like?
So, look, when you talk to your managers, your external managers or your in-house managers, and you're beginning to choose them in the first place, you do talk to them about their investment beliefs, their culture, etc., as a first level. Can you enshrine that into an investment mandate? No. You've just got to do that as part of your review selection process. But then the next layer of things, you can begin to build those into the mandates. And that could be around active voting. What are you doing in this area? Is it tick box stuff? When something big comes up, we're going to ask you about that, just to test that out. I mean, that's what trustees are so good at, is asking those really awkward questions. So you can put that in the mandate. Engagement and dialogue. Can this manager do that for you? Some of them can, if they are engaged with the companies in which they invest. Some of them can't. Maybe they're quant funds, or maybe they don't have access to the company management, not deep access. So don't expect that. So don't build that into that particular mandate. But where you know that an investment manager can, put that into that mandate and then measure against it. What have you done with XYZ example? Every day we're getting front page examples of risks coming up within management. You can talk to your managers about this. It's in the investment mandate agreement that they're going to do it, or it's not, in which case a third party might do it for you, if that manager doesn't have the skill or you don't have the in-house skill to do it. But those sorts of things, they can be built into the IMA.
Yeah. Nick or Rob, do you wish to add anything further to that answer?
Sure. I mean, let's take three different funds. An Australian equity passive fund, an Australian long-only benchmark agnostic valuation-driven fund, and then an Australian long-short. Now consider banks in that. Banks, the four major banks, if you had a typical holding of passive and international as well as domestic, you may be surprised to hear that you have more money in those four banks than you do in all of Europe. So is that necessary? How do you employ that stewardship if you're taking a very passive approach? How is your manager going to do it? Or is that really incumbent on you? Then, of course, there's a valuation-driven manager where you expect your manager, for the fees incurred, of course, to try to tilt your portfolio where the best value lies. In that circumstance, they may be underweight financials as opposed to being market weight. And then, of course, the last extreme is a long-short manager. Again, it's a valuation-driven manager. They may be actually short the banks because they view them as too expensive. So in each case, how you engage with your manager and expect them to engage, and again, in a forthright way, will vary differently.
Okay, so if we have implemented capital stewardship principles in our funds, or even if we haven't, but we want to still have a think about how we're doing in that area, how do we measure performance of mandates, but also our own performance from a governance perspective across these areas? Have you got any sort of tips or practical advice that we can take away and consider further?
Well, I can lead off with that. I mean, from Aberdeen's perspective, what we do is integrate capital stewardship, ESG, is an integral part of the investment process. So it's, we don't have a control group. This is the challenge with capital stewardship. We don't have a control group that we can point investors to say, oh, look, had you not followed a prudent capital stewardship approach, you would have been looking at this portfolio. Given you have followed that approach, you're looking at this portfolio, here's the difference between the two. It's not as easily done as that. You know, looking at, if I take some practical examples, we've been fortunate in winning quite a lot of money recently from German pension funds looking in fixed income space who are looking very explicitly at pre-screening from on a variety of factors, and we can tailor those factors to each individual client. Now there, the bogey that we can show the alternative for is simply the index. Their other approach could have been passive. So there you can tangibly say, look, as a result of your decisions, Mr. Client, to say steer away from munitions, steer away from tobacco, you know, only insist that you invest in companies that don't have any power generation from coal, for example, and we can do that screening using things like Sustainalytics. There you've got a control group to compare against. However, that type of explicit ESG screening isn't really used in Australia yet to a great extent. So it's actually quite hard to sit there and say, oh, your alternative would have been this. So, you know, it's a very difficult question to answer in the broadest sense, just looking at capital stewardship. If you get more micro, then you've got a control group to compare against. Yeah.
I mean, one of the ways we do it practically, which we then give to our clients and they question us on and interrogate us, but then they put that into their own processes and put it onto their websites and communicate with their members, is when we're doing voting engagement, we might engage on, say, the top 350 or top 400 stocks within their portfolio where there's material ESG risks. So that works out to be quite a lot of, we identify the company, what the material issue is, we do an objective, and then there's 4 milestones within that objective. So we actually track, have we reached milestone 1, milestone 2, milestone 3, milestone 4? Have we actually reached that objective? Now, in about 40% of cases per year, we do. This is a rolling period, actually, of about 2 to 3 years. So we can very explicitly say, this is what we're engaging on, this is where we are. We've had success, as I say, about 40% of cases, and then we leave the clever financial impact to the academics, because if we did it, you know, we'd look a bit vested interest, so we get independent data set and give it to some academics to try and look at what impact has that had on performance, and then they begin to filter the results through. It's early stages on that part, I have to say. But this is something that people can interrogate us on. Ultimately, it's on their decision to go with engagement as well, so they can interrogate themselves upon it as well. So you can measure it, but you've got to identify it, track it, all the classic stuff.
Okay, now we'll make this the last question, but there's a question on the screen about do funds need to take greater control of their investment management function through increased internalisation of investments in order to become a better capital steward? So perhaps we've got time to hear from one of you on this, and Rob, you've leant forward, so I'm taking that you've got something to say on this, so perhaps in about 1 minute, if you could have a go at answering that, please.
It says 2:55 there.
Yeah, it's got
I've got to sum up. And we've got one final question to ask the audience.
I'm the poster child beneficiary of internalization. I was flown out here to work with AMP's internal team long ago for the number 1 fund. And then from there, I went to New South Wales State Super. And when we were eventually sold, Elizabeth Brine, the then head of the organization, flew out Keith Ambekshire. And we went to Michael Egan's office on Macquarie Street, and we said why internalization works, why it adds value, et cetera, et cetera. Michael Egan asked a great question to Keith Ambekshire. Mr. Ambekshire, at the end, do you have insurance? Yes. Do you have car insurance? Yes. Do you have home insurance? Yes. So every day that you don't crash your car or burn your house, are you upset because you just lost money? Answer is no. So how do I recoup my money when my internal fund blows up? If you blow up as an external manager, I can recoup my money. So yes, there is a cost savings, but there's a cost associated with that internalization. So I'm speaking as someone who was within that structure for much of my career. And it wasn't really until Michael Egan asked that question I had an aha moment.
Okay, thank you, Rob. Now let's get the final question up on the screen to conclude this session. So the question is incorporating capital stewardship principles into profit for member super fund investing, firstly, very important, secondly, well worth considering further, or finally, there are more pressing priorities right now? For those of you with phones, can you please indicate your preferred answer? And whilst that's happening, I just need to remind you to please rate this session at the conclusion of it, which is happening shortly. The conference app supported by Maple Brown Abbott has the ability to rate each session over the course of the next 3 days. So let's get those results back on the screen. And well, panel, it looks like you've convinced the majority of people here that capital stewardship principles is at least well worth considering further. Most people think it's very important. A few people, though, have some priorities that are a bit more important at the moment. So an interesting
Guys,
result.
that's brilliant. But
It's
you know, in
yeah.
different regions around the world, it'd be the other way round. Be it
Okay.
in the US or
So you think if
some
we're in
other
the US,
countries.
we'd be looking at
I think you'd
it'd
turn
be
it
upside
around.
down, would
Yeah,
it?
I
Okay.
reckon. Well, that's what people admit to anyway.
Yes, okay.
Yeah. So that's brilliant.
All right, wonderful. Well, please, ladies and gentlemen, thank our panel.